We are taught a logical rule. If a company builds a strong product and hits its targets, we expect a steady climb in its value. But modern financial markets do not always run on that logic. Today, a company can deliver flawless results and watch its stock price crater anyway. Take Autolus Therapeutics on Friday, March 27th. They presented a textbook example of this contradiction in action. This visualization breaks down their operational report from that day. They published a massive $135 million revenue forecast for 2026 and backed it up with a 92% real-world success rate for their clinical treatments. By any traditional metric, financial and biological data that strong should trigger aggressive buying and send the stock soaring. Look at this line chart. Instead of climbing, the stock was crushed. It plummeted until it hit a hard floor at exactly $1.21. This severe drop followed a mechanical response dictated by the corporate calendar rather than an organic human reaction to the data. It happens during a phase called the pre-earnings news vacuum. This is the mandatory quiet period where a company is legally restricted from releasing any new information to the public. As human-driven news stops flowing into the market, unfeeling algorithms take control, shifting the market's focus from fundamental value to automated execution. This algorithmic hijacking happens across the entire market. You see the exact same patterns weaponized against massive giants like Boeing and Eli Lilly. This stock chart maps out the first phase of the cycle, the walk down. The algorithms use the silence of the news vacuum to systematically push the stock price lower in rigid clinical steps. The math has a very specific destination. They walk the stock down to test the exact price floor established over the previous 3 months. They target this specific low for one reason: to intentionally trigger retail stop-loss orders, automated sell limits everyday investors set to protect themselves from big losses. This initial decline has zero connection to the company's biological research or actual financial health. It is a mechanical trap built to manufacture human fear. When those stop-loss orders trigger, everyday investors see their screens flash red. They react to that sudden drop, succumb to manufactured fear, and begin panic selling. While retail investors panic, financial institutions operate on a completely different set of calculations. This bar chart compares normal trading activity to what happened to Autolus on March 27th. There was an extreme volume surge of 4.85 million shares traded, nearly 2.5 times the daily average. Massive financial institutions parked right at the bottom bid, acting as a sponge. They absorbed every single cheap share dumped by payment retail traders. While gathering all that inventory, the sponge actively suppresses the price. They refuse to let the stock rise until their pockets are completely filled. This washout executes a highly efficient algorithmic transfer of wealth, moving capital from retail investors directly into institutional accounts. Once the institutional sponge is full, that artificial downward pressure is finally released. This triggers the last mechanical phase, the rubber band effect. The very next day, Autolus's stock immediately snapped back with a 7% reversal. The rubber band stretched as far as it could, and then violently snapped back to fundamental reality. This situation exposes an integrity crisis in the modern market. Computer programs now dictate the price of life-saving biotech companies based purely on calendar dates. Regulatory bodies like the SEC need to step in and limit the disproportionate control these high-frequency trading schemes hold over individual equities. Until that happens, the stock market remains an asymmetric battlefield where machine logic consistently preys on human psychology. To survive the news vacuum, retail investors need a defensive playbook. We call this the Aegis strategy. Rule number 1, choose patience over panic. Extreme retail price drops, like an artificial 6.2% slide, are often the most reliable buy signals in a rigged game. Rule 2, spot the sponge. If you see a massive volume surge right at a historical low, it tells you that institutional selling has ended and the buying has begun. Algorithms can exploit a quiet period to temporarily hide the truth, but the hard biological and financial data always wins out in the end. By understanding the mechanical life cycle of the algorithmic washout, you can protect your assets and refuse to be the liquidity for someone else's profit.